Okay, so good morning, everyone. Welcome to the new week and the macro snapshot. We are Monday, April the 14th, 2025. Okay, so over the weekend, we got a little bit more confusion. I guess everyone's seen all the headlines that there seems to have been some sort of exemption for Apple products coming into the US in terms of the tariffs. And so there's been a little bit of a sort of a small relief rally, although we had yesterday Howard Lutnick, who's the trade sort of secretary, basically saying that that was only itself a little bit temporary and there would be some kind of tariffs on Apple products probably coming in the next few weeks. So there's a lot of confusion. And I think the market at this point is either sort of holding off on investment projects or getting a little bit frustrated. There's just like a lot of confusion out there. But in theory, there does seem to be some idea that some of these huge American companies, the Apples of the world, the Nvidias of the world, maybe sort of putting political pressure on the Trump cabinet to get sort of carve-outs and exemptions. And it looks as though that at least in some shape or form that is happening with Apple. So, could we see a bit of a relief rally today, especially in the NASDAQ? It's absolutely possible. What we also have today, we have Waller from the Fed. He's always quite sort of intellectually interesting, and he could give us more of a sort of a theoretical framework of what the Fed is thinking at the moment as they try and navigate it. So let's look out for Waller. We also have, importantly, a pretty big day on Wednesday. We have, I think, retail sales on Wednesday. We also have Powell. So we have Waller today and then Powell himself on Wednesday. So that's going to be super interesting. And just talking about retail sales, just having a think about that, I think that's going to be quite an important number. Let's try and figure out if it's on the 16th or not. Yeah, it's on the 16th here. There's not a huge amount. We have Empire and then we have retail sales, but retail sales should be quite interesting. And I just wonder if it's a little bit asymmetric. And why would that be? That's because if it comes in higher than expected, kind of better than expected, will the market sort of explain and justify that by saying that there was a front running of tariffs, that everyone was buying a lot of stuff before the tariffs hit? And so in a certain sense, we could ignore any good news from the tariff scenarios. So in that kind of scenario, situation, if the equities have a big sort of rally, that could be an interesting sort of entry point for those who might want to be going long. On the other hand, if the retail sales on Wednesday come in sort of weak, that will sort of start to give a little bit of sort of energy to that sort of thesis that, oh my God, the recession is coming, and so the recessionistas. So it's an interesting one there, and I think that it looks as though, in a certain sense, there could be a little bit asymmetric towards the downside in equities. Okay, but let's just sort of pull back a little bit, as I like to do on Monday, and think a little bit bigger picture. I think what's sort of important thing to keep in mind is just where the real yields are, and the real yields here. I've got a bunch of sort of tips up here, but the real yields is in white, and this is a monthly chart. So this is for the 10-year, bit of a benchmark. And as you can observe here, this has been going up quite a lot over the last sort of couple of weeks or so. And we're now at levels at about, well, it's just gone off a tiny bit this morning, but we're basically getting up towards that 2.3% level. And if you go back, let's say 5 years, just to put in context. So again, it's the white line. You can see here that we're now at levels which are approaching some of the highest real yields, almost 2.5%. We're getting towards, and it could go up towards that as a sort of a near-term target. And this is the highest real yields we've had for 5 or 6 years, certainly pre-COVID. And even if we go back quite a long time, just to get a bit of sort of context here, let's go back 25 years just on a monthly chart. You can see here that we're here, about 2.3, 2.4, 2.5, somewhere around about here. And you can see that just in terms of context, this is some of the highest real yields we've had for a long, long time. So my point here is that this is going to continue to put pressure on any kind of risk assets, because if the real yield is paying you, in theory, sort of risk-free about 2.3, 2.4%, that becomes relatively sort of attractive at this point, and it will be continuing to put pressure on risk assets. What's also interesting about this chart, just want you guys to have a look at this, is the TIPZ, which is the one which is highlighted here, this kind of apricot color. And what you can see is that the tips, this is the tips, it's the longest duration tips, which of course is kind of like a real yields. And what this is saying is that the level, it's getting down towards levels which are sort of quite low, and that's indicating very high real yields. And the point is that if it goes below, that's been hard to see here, but if it goes below this recent low down here, which is around about kind of 50 and a half or something like that, that's not a good sign. So if the tips, so keep your eye on tips is basically what I'm trying to say, because if it dips below, that's going to get quite nasty for sort of for risk asset pricing. Because what that'll be indicating is that the real yields are getting higher and higher, and that's just going to become at a certain point untenable. And as I say, I've got up here, a lot of people use the TIP, the tip, but if you want to go for the longest duration one, it's TIPZ, which I think is PIMCO, who do that. And that's pretty interesting. So I'm going to be looking at this level here, which, as I say, is about 50 and a half on TIPZ. It should bounce off there, hopefully. It could be interesting kind of buy. And, that could indicate sort of some kind of short-term top in the real yields, which could be a kind of a positive. But the thing is here is that if the real yields do continue to go higher, so getting back to the real yields themselves, if they continue to go a lot higher, let's say they get above the 2.5% level and go up to 2.75 or even up towards 3%, that's going to put a huge amount of pressure on asset prices. And that could lead to some kind of Fed intervention, because historically the Fed doesn't really like sort of real yields to be sort of higher than that. And it's almost that's too much pressure on the real economy, on real assets. And that could be the moment to buy equities. So all that to say, keep your eye on where tips is, keep your eye where the real yield is. And if it gets any higher than 2.5, 2.6, 2.7, if it keeps on going up, that really could be the genuine low point where maybe the equities are under so much pressure that the Fed feel obliged to come in. So that's just something which really you should keep on looking at. And just why are these real yields going up? It's because the nominal yields we know are going up a lot. And if you look at inflation expectations for the longer term, so again, just looking at the real yield here, which you see has been going up. But then if we look at sort of inflation expectations, so I want you guys to look at the 10-year here. So you can see that in the front end of the inflation swaps curve, this is inflation swaps, so what the market is pricing for inflation 1 year into the future. You can see for the 1 year here that it has gone up significantly. So there's like definitely sort of concerns about short-term inflation. But if you go out the tenors here, you go out to the 5, the 7, the 10, and the 30, you can see that, they've risen a tiny bit, but essentially they're relatively flat. So if you look at the 10-year, which is this sort of orange one down here, you can see it hasn't actually risen that much. So what has been happening is that the nominal yields are going up a lot. Inflation expectations for the 10 and the 30-year are actually remaining relatively anchored. So what's happening here is that the differential, which is the real yield, is actually is getting higher and higher. And eventually that is, putting more and more pressure in theory on risk assets, or at least in my humble opinion, that is going to prevent risk assets from having a really sustained kind of rally if those real yields remain high. So keep an eye on the real yields, the tips, inflation expectations, and the relationship with the with the equity kind of market. Okay, so if we just have a quick look and see what happened last week, I mean, essentially what we seem to be getting was some kind of deleveraging and some kind of liquidation of US dollar denominated assets. And a lot of people started sort of saying, and it is interesting that the US dollar and the yields in the US, they started almost acting a little bit like an emerging market, or at least maybe the closest recent analog was what happened in the United Kingdom, what was it, 2 or 3 years ago with Liz Truss, where she basically had unfunded tax cuts, massive tax cuts, and the bond vigilantes essentially pushed the cost of borrowing up very dramatically, so the yields on the long-term gilts ripped super high. And we're almost getting that situation here with the US, where basically the yields are going up in the US, the nominal yields, but the US dollar is weakening. And if we have a look at a couple of charts here, just to put this all in perspective, which we'll do, well, we can see here, I've just got the FX sort of trend board here from Saxo, which I like to look at every Monday. And you can see here that if you look at the broad US dollar here, it's been pretty red if you go back to the last, 15, 20 days or so. And you can see, if anything, it's getting a bit stronger. So definitely sort of a negative kind of trend in the US dollar index. Just while we're looking at that, you can see that gold continues to be very strong. It's come off its absolute highs. You can see here that it had a crazy trend, outperforming silver here, XAG. Euro still doing pretty well, but just coming off a tiny bit here. The Chinese renminbi sort of weakening here. What has been very strong is the Swiss franc. And I can just show you, if you look at the Swiss franc here, this is interesting because it's so strong. It's come back a little bit just this morning, but look at this strength in the Swiss franc, obviously as a safe haven. We're also getting interesting this whole idea of repatriation and flows back into into Europe essentially, and to a lesser degree into Japan. And if you just look here, I've got the 2-year yield for Switzerland. So this is the Swiss 2-year yield. And what you can observe here is that it's actually negative. So yes, we are getting back into negative yields, which remember we haven't had for quite a long time. And that's getting back to, as I say, it's literally sort of negative minus 0.6 basis points here. And so could we get to the point that the Swiss National Bank will start to get even a little bit concerned because with this very strong franc, which it's not good for their exports, it's not good for tourism, and it's driving down inflation to sort of almost worrying levels of deflationary levels. We have a very strong Swiss franc here, and they could get to the point here where they might have to start thinking about cutting their overnight interest rate sort of benchmark to negative. So just keep an eye out what's happening with the Swiss National Bank, and a good proxy for that also is just to look at this 2-year bond yield, which, as I say, is going negative. So a lot of strength here in the Swiss franc, especially against the US dollar. Euro also doing pretty well, and the US dollar doing weakly. And what I just wanted to show here is just to look at like the dollar index here. And we can see, where's the dollar index? Well, just look at the yields here. So actually, we'll just take it a bit more systematically here. So it does seem that we're getting a lot of sort of US assets are being sold by Europeans and the Japanese investors, and that money is being repatriated back into the German bunds. We're seeing that the bund yields have actually come down, and we're also seeing that as we say, the euro's having some strength. So what's kind of interesting here is though this idea is that we should be avoiding long duration, and why should we be avoiding long duration? Because as we've seen, the nominal yields are going up. Inflation, at least for the short-term expectations, are going up with the tariffs. And so what we're probably going to keep on getting is kind of steepness. So if we start looking at some of just the bond yields to see what's going on here, let's look at the US. So you look here at the 30-year yield here. It looks like 5% was kind of the line in the sand, maybe for Besant, maybe for Trump himself, and certainly for the market. So at the moment we had the 5% yield. But if this comes down a little bit, at this point, if you actually look at what Doge has done, there's not really that much of a difference to government sort of spending. Government spending remains very, very elevated, even though they're desperately trying to cut. But government spending remains very, very strong. If there is to be some kind of recession, there's going to be more government spending because there's less tax income and there's more benefits going out. So that's going to change the equation. It's actually going to be terrible for the government deficit. So it would not surprise me to see if the US 30-year yield maybe comes in a little bit, but at a certain point, could that push up to, maybe, up to 5.25 or something, or even, 5.3 or 5.4, over time. And if you actually have a look at, let's say, the weekly chart here, just to put this all a little bit more in perspective, getting up towards, 5.17, 5.2 is absolutely not out of the realms of possibility. And if you actually just look a bit longer term here, you can see that it's also not at all inconceivable to get up to 5.38, 5.4, 5.5. We're not that far away, and it looks as though we are, in a sort of a bit of an uptrend at the moment. So if that's the case, one would, the idea is that the curve should continue to steepen, and one would sort of think that the US dollar might strengthen, but it's not. As I said, there's a lack of confidence in US denominated assets. There seems to be some kind of flows and positioning at the moment. So at the moment, the market does seem to be driven by flows and positioning, and the relationships are a little bit broken. Can they come back? Yeah, quite possibly. What's also kind of interesting, just to look at these flows, if you look at the differential between the US and the German. So look at this over the last week. This is incredible here. You see the US 10-year has absolutely ripped like that. And if you put that on a weekly, it's just like this massive green candle. So what we're seeing here is there definitely some kind of flows back into European bonds, and also into European sort of currency and whatnot. And it's just going to be interesting to see if the ECB this Thursday, they have their meeting, if they have anything to say about that. But the differential, the relationships are breaking down. I just want to show you guys something here just to show that. And you can see here, this is the dollar index, so which is very similar to so look at the dollar index here, and you can see that the dollar index has come down a lot. We're now below 100, and look at the US yield. So as you can see, this historically has been very, very correlated, and this relationship has broken down a little bit. Now, what's interesting, will this come back together? Most probably at some point, but it could be a question of weeks or months when that starts to kind of come back in together. But definitely, this is signaling, a breakdown in certain relationships and a lack of confidence at this point in maybe the US dollar and trade policy, the Trump administration, and US assets. And then that potentially could be a big issue because if the market stops, sort of worrying about or having sort of, if the market stops having confidence in the biggest bond market in the world, that could be a real issue. But we're not quite there yet. And I think, Besant is looking at that. Okay, so what has been interesting as well is if we just look at the German 10-year, and what we can see is that the German 10-year yield, as opposed to the US 10-year yield. So let's just quickly have a look at the US 10-year yield. So we see the US 10-year yields actually sort of going up on the week. This is the weekly chart. Let's put on the daily. So you see on the daily, you see the US 10-year yields been going up, and also the 30-year yields been going up a lot. But as soon as we flip back to Germany, you can see the 10-year yield in Germany has actually come down a little bit. Now, as I say, a lot of this is probably flows. Big funds are probably, getting out of US stocks, and with those US dollars being converted back into euros, it's pushing up the euro, and a lot of that money is probably being bought just to being parked in bunds. And also at the 5-year here and the 2-year here in Germany as well. You see there at the front of the curve has come down a lot. But it's interesting because let's not forget that Germany is itself reflating, and Germany itself is actually spending about a huge amount of money on infrastructure over the next few years, and specifically on defense. And so there was a big hullabaloo when that news sort of came out. We saw the yield spiked here. Look at this huge gap in the German yields. But what's interesting now is that we've now come back to almost this 2.5% level. Based on these flows and positioning. And you have to say, I think it's going to be quite difficult, in my humble opinion, for the German 10-year yield, considering that they are reflating their economy and spending, €1 trillion on infrastructure, to get below the 2.5%. So I've put an alert here at about, basically about 2.49. If this yield gets down here, I think this is going to be an interesting case here to sort of buy the yield, or actually to sell the futures, so the FGBL, so the 10-year bond futures here, because I think this is getting a little bit overdone here. And as you see, we're filled in this gap. It's as though the infrastructure spending is not going to be happening. So I get it in the short term, but I think that is an interesting one to keep an eye out there, is what's happening there in the German yield. And if we consider that, I think that over time that could get up to, maybe up here, 2.85, or even push up again towards 2.95 over a bit of time. This does seem to be a lower limit. There's 2.5 here. What's also interesting, just talking about Europe, is that on this risk-off flow, it is kind of interesting to finally see a few cracks in some of those spreads. So if we look here at the Italian-German, you can see that finally it broke out of this range. And we're now creeping up to about 1.25% in terms of the differentials. As I've been saying for a long time, this is at historically pretty low levels, and it assumes sort of a perfect world of low risk and everyone's happy. And it is true that the Italian bonds did receive an upgrade the other day. I think it was from Fitch, was it? About a week ago. I think from BBB minus up to BBB. But anyway, the Italian bonds did receive an upgrade. So that is just interesting there, like the first little, very small signs of cracks, a little bit of stress here as the Italian-German spread is just going up a little bit. And we also see here, if we look at the French and German spread, that too, over the last 4, 5, 6 days has started to creep up a little bit again. So just a few signs of a lack of confidence there, and some kind of traditional relationship of the peripheral spreads being a little bit more than the core kind of German spreads here. So let's keep an eye on that. And I think in the Italian one, probably like 1.22, that seems to be like a sort of interesting kind of level there, a bit of a pivot point. Again, so with this huge sort of uptick in the nominal yields in the US, one would have expected, as I was saying, for the US dollar to have rallied. That's the historical relationship. But as we all know, that hasn't been the case. And what's actually kind of interesting here is that we had the critical level of the 100 in the dollar index. which was basically broken, which is a big sort of purple line here. It's now below this sort of, long trading range, which was this lilac sort of box here. And we can see that it broke stops at about 99 and a half. But what's interesting is that I thought there'd be a little bit of a bounce just on this sort of, the news over the weekend that Apple would be getting some kind of reprieve or reduction in tariffs. But I think maybe Lutnick, as I said, the trade sort of commissioner, coming out and saying, "Oh, that's just temporary, and don't worry, we're going to have semiconductors, we're going to have tariffs on semiconductors as well." And so the US dollar hasn't received much of a bounce at all coming in to here Monday morning session, and still under quite a lot of pressure here. I mean, I do think, if the US dollar were to bounce, let's say up to, I don't know, something like this, 101, 80, 101.90, this kind of level here, I think it's probably still it's probably a little bit of a sell still. And it's the same if you look at the euro. The euro has been doing pretty well. I mean, just looking at the news, you can see the Aussies had a little bit of a bounce recently. If we look at the euro here, doing quite well. So again, the US dollar not even benefiting from that weekend news. But the euro is an interesting one here because it's now sort of out of this trading range. It seems to have established 112 and a half as almost like a support level now, whereas that was resistance. So the euro doing well. Again, repatriation flows. It could have a little bit of short-term dovishness. Or sort of negativity if the ECB cuts this Thursday. Let's see what Lagarde has to say. But getting up to very interesting sort of resistance level at about 115 here. Now, if it comes down, it could come down a little bit. Who knows? Maybe we get some kind of sort of bull flagging situation that it kind of consolidates in a flagging situation for a week or two, and then potentially it could push up a little bit here. But you probably want to wait until it comes back down a good chunk, maybe to 112, something like that. 112 and a half looks like a pretty attractive entry level if it does get there. So other things which is interesting is commodities. Now, if we were looking at commodities, actually just thinking about metals as well and the euro. If you look at gold, we know that gold's been doing pretty well. And I saw over the weekend there was some kind of comment. I think that the Chinese, the PBOC, has basically even sort of suggested to commercial banks to allocate even a little bit more of their sort of reserves to gold. So there continues to be quite a lot of good news for gold, structural news about sort of central bank buying. There's obviously inflation worries. There's also just general geopolitical concerns and concerns about the stability of the US policy making. So gold, making new highs is doing very, very well. But it's interesting because this is priced in US dollars. So we see here, this is the US dollar chart, gold price in US dollars, which obviously is at 32.25, very strong. But I just want to draw your attention to gold priced in euros. Not quite as strong, still a very strong chart, but not yet making new time highs. So just keep in mind that part of what's driving gold is definitely US dollar specific and its US dollar weakness. So if we were to see some strength in the US dollar, we could see gold just having a little bit of a pullback here. So keep your eye also just what gold is doing against other countries, especially the euro. But for sure, gold doing pretty well. Just right on the metals here. Silver's had a very nice bounce. Interesting here to look at this Fibonacci. It's now coming up towards the 61.8%, 32 and a half. That's going to be very critical. It's probably going to depend on gold. Keep in mind, silver is a little bit more sensitive to the industrial cycle or the sentiment in terms of the real economy. So, if the market doesn't have a risk on sort of bounce back today after this sort of reprieve for tariff, there could be a little bit of profit taking here for silver, as I say, at this sort of a fib level, which is about 32 and a half bucks. But so far, so good, looking quite good. Interesting also to see what copper's doing. Copper is displaying a little bit of a risk on sort of bounce, doing quite well. Again, getting up towards a fib retracement levels here. Let's have a look at it. I'll put it on. This is for the high grade. There's no reason why copper can't sort of push up a little bit more. It's still up to the 50%, or maybe even to retest the 490 level, which would be sort of, quite a nice level to take a pause. What is interesting just in the general commodity space is, I'm just going to put up a general sort of ETF here. So let's put up a GSG, which is the general commodities, is it's having a little bit of a sort of pulling itself off the floor. But at a certain point, commodities, even if the global economy is not ripping the global economy, there's a little bit of sort of a negativity in terms of the sentiment. The fact that the US dollar has been so weak, most of these commodity trades are priced in US dollars, as we all know. And at a certain point, these commodity producers will no doubt, will want to have, a little bit few more US dollars basically to compensate for the debasement in the US, in the value of the US dollar. So interesting here to see there's kind of like a tug of war at the moment in commodities. We have this debasement or devaluing of the US dollar, which ordinarily would be, good for the commodity pricing. But on the other hand, there's a kind of quite a lot of negativity surrounding the commodity complex in terms of the global economy. If the GSG gets down a little bit more, I mean, it's interesting. Is this trade missed? I was hoping to see it down more at sort of 19, $20, something down around here. But that's an interesting one. Let's just see if commodities can pull themselves up. And just while we're on the commodities, we can have a look here at oil. And you see oil, again, trying to have a little bounce on this sort of, so-called positive news out of the weekend. I mean, not bad. It's went through all the stops. It's been a pretty brutal sell-off here, but this does look to be some kind of sideways consolidation. And again, as we all know, most of this is priced in US dollars. So, if the US dollar continues to weaken and the global economy remains relatively solid, I don't know that I see oil ripping, but there could be some kind of grind upwards. And there is some sort of talks happening at the moment between Iran and the US. Let's see how they go. Are they going to turn into sanctions, or could it actually be the opposite and sort of positive for Iran, in which case any new oil onto the market might actually be a negative. So let's keep an eye also out on that. Just finally, guys, want to have a quick look here at volatility and the equities. Volatility obviously has been extremely high. I would say, just looking at the chart, that this level of around about 30, as you see here, it's a pretty key level here in terms of the VIX. I would say that if the VIX bounces off this kind of 30 and goes higher, that will signal that there's still potential downside pressure in equities, the equity sell-off, and there's more to go. So I'm going to be watching this 30 level quite carefully in the VIX. And just see if that holds. If it holds, I think it's kind of a negative sort of indicator for the equity market. On the other hand, if the VIX can sort of push down through this 30 handle and get down, down towards, down here, somewhere like, 20 or something like that, that could be a positive and could start signaling that, equities have found some kind of level. So just looking at the equities, what kind of levels are we looking at? Let me just put it up here. I mean, as you can see, if we put it on the ES, so we put it on the futures, which are open, we can see the futures have a little bit of a bounce this morning, about looks like about 70 points or so, up over 1%. So that's a nice little bounce. But really, where can this get to? A lot of people are talking about the 5,700 level. This is a bit of a sort of a fib retracement level of the big move down to 61 points. And I think there, if you do get up to 5,700 for sure, that is going to be interesting because multiples are still quite elevated. As we see the earnings seasons coming in, are we going to sort of see a little bit more negativity? We had Jamie Dimon last week being, quite sort of circumspect about the economy. So I'm just thinking that this 57 level here personally could be an interesting level to start thinking about, sort of long put spreads or something like that. If we look at the SPX, just to, cleaner on the sort of the cash market here, you could see that, again, that would equate to something like well, it's pretty similar, about 56.75, something like that. Okay. All right, guys. So I'm going to leave it there. Just keep in mind, we had the not JP Morgan, we had Goldman Sachs this morning. We had the earnings. I had a quick look at those. They seem to be relatively positive, at least in terms of some of the FICC performance. So we had Goldman's this morning. We have United. It's going to be interesting, United Airlines tomorrow after the close, because there has been some sense that discretionary consumer spending has been going down. So United Airlines, interesting to see if they have any comments about spending sort of going down. We get the home builders. That's going to be interesting. On Thursday, we have DR Horton, the home builders. I always like to see their comments. Of course, we have TSMC, semis, Netflix reporting on Thursday, Bank of America, Citi, Johnson and Johnson. So we do have some interesting names. Keep in mind, of course, it is Holy Week, so we have Easter Friday, Good Friday. On Friday, the markets will be closed, and so I think there could be a bit of a diminishing of liquidity and sort of volume as we get towards the end of the week. But as I say, before we get there, we do have Waller today speaking from the Fed. We have Powell on Wednesday, retail sales, and a few quite interesting earnings coming out. I'm just going to do a final quick flick through here just to see that there's, let's have a look, no headlines, which I've missed as we speak here, just after 11 o'clock. Goldman Sachs first quarter equities trading revenue 4.2 much. Okay, so Goldman Sachs equities trading did pretty well. Looks like the fixed income was a little lower than expected, so that looks quite solid. Okay, guys, I'm going to leave it there. Have a great week, and we shall keep the conversation going. Thank you.